Welcome to the review session for exam number 3 for managerial accounting, the 16th edition of the textbook. So this exam covers 4 chapters, chapters 22 through 25. And you can see in the practice set that we have quite a few exercises here spanning those 4 chapters. They are all brief exercises. You can tell by the BE at the beginning. And so this shouldn't take as long as it might seem to work through all of these exercises. As always, if you have questions that are not answered by this video, you are certainly welcome and encouraged to ask for additional assistance. Also, keep in mind any of the exercises that have this .algo at the end, that means algorithm. And so the numbers in my exercises are likely not going to match the numbers in your exercises. And so as you work through the exercises on your own, you'll need to do the same calculations, but using the numbers in your exercise if they're different than mine. To find this practice set, remember that you need to go to the assignments I can practice now or all assignments option within Cengage CNow, because they are not listed under the assignments I can take now, which is the default because they are not graded. So let's get started. I believe your exercises should be in the same order that mine are. And we're going to start with the exercises for chapter 22 and work our way through. Cabinair Incorporated is one of the largest manufacturers of office furniture in the United States. In Grand Rapids, Michigan, it assembles filing cabinets in an assembly department. Assume the following information for the assembly department, and we are given the direct labor and the amount for supervisory salaries, depreciation, and those are going to be overhead amounts and or fixed costs, and then the direct labor rate there. Prepare a flexible budget for 10, 13, and 15,000 filing cabinets for the month ended February 28th in the assembly department. And so the idea of the flexible budget is it allows us to look at a range of different options within our relevant operating range to see, well, what would our budget look like if this happened? And so we know that those fixed costs of supervisory salaries and depreciation are going to remain constant or remain the same every month, regardless of our level of activity, the amount that we produce. That's what fixed costs mean. So I'm just going to go ahead and put those in now. And this is a 1-month budget, and those are both given as monthly amounts. So keep in mind, you have to pay attention to your labeling. So this says per month, but certainly it could say per year or some other or unit of measure. And so our total fixed costs for each month are going to be $146,000. This is one of those times that using an Excel spreadsheet would be beneficial for us because we could just plug in our calculations, use the formulas, and not have to keep repeating the same work over and over. And so our direct labor, the only direct labor we're provided the only variable cost we are provided is the direct labor. We're told that each filing cabinet is going to take 20 minutes and the cost is $15 per hour. So again, we need to pay attention to our labeling. So if we produce 10,000 filing cabinets, which is the first piece of the first version of the budget that we are going to calculate, 10,000 cabinets at 20 minutes per cabinet is 200,000 minutes, but we want to express that in hours. So of course we would divide by 60 minutes, and that would give us a 3,333.3333. Continuing, so that's 1/3 of an hour for that last filing cabinet. Multiply that by $15 per hour, get our direct labor, and that gives us a total cost for direct labor of $50,000. Now, again, if we were using Excel, this would be very easy because we would just plug in a formula there. But we're going to do the same thing for each one of these. That is multiplying the units by 20 minutes per unit, dividing by 60 minutes per hour, and then multiplying by the $15 per hour rate. Now it's fairly typical in a flexible budget like we are doing here to have the 3 different versions. I like to think of these as the best case, worst case, and most likely scenario. So for this company, our relevant operating range would be from 10 to 15,000 cabinets, and we expect to make somewhere in there, but we don't know exactly where. And this allows us to see what would happen with our overall budget if we were to, flex within that relevant operating range. And so now I'm just adding together the total fixed costs with the total variable cost to get our total departmental costs for each version, each level of activity. And we can click the check my work button just to get our green check marks in there. So this is going to be very helpful for doing those, what if kind of scenarios. So what if we only make 12,000? What if we make 15,000? What would we expect to happen? So chapter 22, of course, is the budgeting chapter. And we know from the discussions, if you watch the videos, from the discussions that all budgets are going to start or should start from a sales budget. So if we're using that concept of pull-through production, which is we produce because we have a customer, because we know we can sell it, not just because we have capacity, but because we have a sale or a projected sale, then we start with that sales budget. And from that sales budget, we're going to determine, well, how many do we need to make? And that's what we're doing here in the next exercise. I have no idea what the name of this company is. Quetzal Tango. I skipped a syllable. Candle Incorporated projected sales of 60,000 units, 60,000 candles specifically for the month of March. They expect to have 4,200 units on hand at the beginning of the month, and they want to have 7,000 candles on hand at the end of the month. In other words, they're going to be bumping up their inventory. They're going to be producing some extra candles beyond what they plan to sell. Why would they do that? Well, maybe April is a big candle month. So again, with that concept of pull-through production, you're going to produce because you think you can sell it. It doesn't mean you have to sell everything that month. As you can see here, we have a situation where must be they expect sales to be higher in the next month, and they're building their inventory for that busy season. So before we even start putting this in, we know if they want their inventory to go from 4,200 to 7,000, just using your common sense or logical business thinking, we need to produce 2,800 units more than we plan to sell. So if we're going to sell 60,000 and we want to add another 2,800 to the inventory, then we already know the bottom line here, the total units to be produced is going to be 62,800. But how did we get there? Again, I'd like you to be able to think through it, but let's see how we would get there in this format. So we start with the units we expect to sell, 60,000. And then how many do we also want to have on hand at the end of the month? And that is the 7,000. So we need to have 67,000 units available throughout the month or at some point during the month. But we expect to start the month with 4,200 units. And so we don't have to produce all 67,000. We need to produce only 62,800. Again, it tells us enter any number you're going to subtract, use a minus sign. That's why you should never skip through the instructions. You should always read every word of the instructions, which I did not just read. So subtract because we need to put the negative sign in there. So to remind us to subtract. And let's go ahead. So once we know how many units we're going to produce, then we can figure out how much we need to support that. We can do both the direct materials and the direct labor budgets. Keep in mind, again, direct materials purchases is going to reflect the beginning and ending inventory as well, just like we did with the actual candles in the previous exercise. So going on to the next exercise, same candle company. We're budgeting production of 750,000 candles for March, so a little bit different information than what we had in the previous exercise. Wax is required to produce a candle. We need 15 ounces of wax, so just under 1 pound for each candle. Estimated March 1st wax inventory, 17,700 pounds. And then at the end of the month, we want to have only 13,000 pounds. So this is kind of the opposite of what we saw in the exercise. So if we're going to use up some of our inventory and not replace it, and we want our ending inventory to be lower than our beginning inventory, that means that we're going to purchase somewhat less than what we actually use this month. And so we have to figure out how many pounds or ounces are we going to use this month, and then how much of that is going to come from inventory. So in this case, using my numbers, it's 17,700 minus 13,000. We're going to be using up and not replacing 4,700 pounds out of our inventory. And so our purchases are actually going to be less than the amount that we use. So again, we need to, this isn't a usage budget, this is a purchases budget. So we need to take into account any planned changes in our inventory. So let's go ahead. Pounds of wax required for production. Well, we're going to be producing candles, and let's see, 750,000 candles at 15 ounces each gives us 11,250,000 ounces. Of course, you need to know how many ounces there are in a pound, and there are 16 ounces in a pound. And so be sure that you keep, it tells us that actually right there, 1 pound equals 16 ounces. If you didn't know that, of course, you can look that up, whether you're working on these problems or on the exam, something basic like that, that we consider common knowledge. Hopefully they give you this kind of a conversion, but if they don't, it's always fine to look that up. So I took the number of candles multiplied by 15 ounces per candle and then divided by 16 ounces to convert those ounces into pounds. And so I know I need 703,125 pounds of wax. And we want to also have on hand at the end of the month 13,000 pounds of wax. And so 716,125 would be the number of pounds that we need to have available. But again, just like in the last exercise, we need to take into account our beginning inventory. So we're going to, whoops, just like the last exercise, I need to enter that as a negative number. Just doing my calculation here. And so the actual pounds we need to purchase, as we knew before we even started inputting these numbers, the actual pounds we need to purchase is going to be less than that which we are going to use, because we're going to work down some of our inventory. And then what did it tell us? The price per pound was $1.70. And round all numbers to the nearest whole number. So mine came out to 22.5 using my number. So I'm just rounding up that to 23 at the end of that calculation. So again, important to read all the instructions, using negatives where necessary, and rounding to the appropriate number of decimal places. So our direct materials purchases budget is based on the direct materials usage that we calculated here. How much are we going to use? And then how much do we have at the beginning of the month? How much do we expect or want to have at the end of the month? And the price. So our production budget, just as a reminder, our production budget, if we go back to that previous exercise, this was just in units. There's no dollars amounts in the production budget, because that's what all the remaining operating budgets are going to help us determine. how much are those units going to cost us each? So we have direct materials, we have direct labor. Of course, we're going to have an overhead budget as well. All of those together are going to help us calculate that cost per unit. But in the direct materials purchases and in the direct labor budget, we're going to have both hours and dollars involved. And that brings us to our next exercise, which is the direct labor budget. Now, I know I talked about in the lecture videos where this information is coming from. So just keep in mind that we're going to be using participative budgeting. We're going to be asking the people within the company who know how much direct labor we're going to use, how much is it going to cost. We're going to be talking to production. We're going to be talking to human resources to find out how much on average we are paying our workers and so on. So we're not doing this in a back room behind closed doors. We're consulting with the people who know or should know, who has that information. So in our next exercise, that same candle company, but now we're budgeting for 54,000 candles, again, using the numbers in my problem. And each candle is going to take 15 minutes. So of course, there's no beginning and ending inventory in labor, right? We can't bank that labor for from a previous month or bank some for the next month. So you'll notice that this budget has no inventory. Labor is not an inventoriable event. So 54,000 candles at 15 minutes. This is actually building into the template here to convert that to hours, where in the last exercises we've had to do that kind of behind the scenes, if you will. So dividing by 60 minutes tells us we need 13,500 labor hours. And each of those labor hours, clearly this is not in New York State because that labor is less than our minimum wage, but $11.50 per hour for 13,500 hours would give us a total direct labor cost for the budget of $155,250. So what did we do with that? Well, now we're going to feed that back to the to the human resources office maybe and say, this is the number of hours that we need. So I don't know, maybe they take that and divide by 40. And this is for 1 month. So maybe, I don't know if we work every day or if we're only open on Monday through Friday. Let's just say we work every day. We have additional shifts on the weekends or something. Maybe we have 2 shifts. I don't know. But we're going to take these hours and convert it into manpower to see, do we have enough manpower to cover this? Do we need to be, putting out an ad and trying to hire some new employees or whatever? So, again, we can't do this in a vacuum. We do these calculations and then we have to figure out how this information helps us to run our business. That's the whole purpose really behind managerial accounting, is to run a more efficient and effective business. And let's keep going. So now we move on to our cost of goods sold budget. Still looking at that same candle company. Pretty happy with that candle company in this chapter. And every month, every one of these exercises has us producing a wide range of candles. But in this particular exercise, we're going to be producing 685,000 candles during the month of March. Now it takes only 6 minutes to mold the candle, gives us the molding labor cost. Now we're in line with New York State minimum wage, $15 an hour. And we're going to do the direct labor, and then we're going to include for a cost of goods sold budget. Of course, we need all 3 of the component costs that make up any product: direct labor, direct materials, and overhead. So we're going to be looking at all 3 of those given the information that we have here. And as a reminder, again, they tell us we need to use the negative sign whenever we're going to subtract. So let's get started. For our cost of goods sold budget, we're going to start with, well, what do we have at the beginning of the month? And it tells us estimated inventories for March 1st, finished goods, work in process. So we're starting with the finished goods amount. You will notice that this exercise is not an algorithmic exercise, so my numbers are going to match right up with your numbers for this exercise. So what are we starting with this month? $300,000 worth of inventory. What do we add to that? Well, we add to it whatever we finished during the month. So we're now going to be analyzing the work in process inventory account to figure how much did we add to that finished goods inventory. So if you go back to, I think it's chapter 16 in the reference materials folder, you've got my flow chart there, handwritten picture of a handwritten flow chart of the cost flowing through the three inventory accounts. It's either in the chapter 15 or 16 reference materials. So if you want a brief review of what we're doing here with these numbers, keep that in mind. You can go back and look at that flow chart. And so in our work in process inventory, we expect to start the month with $41,250 worth. What do we add to that? Well, again, looking at that flow chart, we add direct materials. So we have to figure out how much direct materials did we add. Direct materials. So this is the ending. Let's see, where's our... Okay, so right there is our beginning balance for direct materials, 15,000 pounds. And how much do those pounds cost? There it is, $1.20 per pound. So we have to keep in mind, sometimes they're giving us dollar amounts, and right here they kind of threw us a little slip because they gave us the number of pounds rather than the dollars. So 15,000 pounds at $1.20 each would be a starting inventory of $18,000. Anything we're putting into this budget, of course, we want to be in dollars. How much are we going to add to that during the month? Let's see. Assume 342,000 pounds of material will be added or purchased during the month. So 342,000 pounds at $1.20 per pound. We're going to add to that $410,400 worth of materials. So the cost of direct materials available for our use would be $428,400. And we expect to have at the end of the month, here we go, 14,500 pounds we expect or want to have available at the end of the month. We need to remember to use our negative because we're subtracting. And so with the data that we are provided, we know that we would be moving $411,000 worth of materials into production. That is, we're adding it to the work in process inventory and adding it to that work in process inventory account. The other two component costs for our product would be the direct labor and the overhead. So let's see, factory overhead is budgeted $400,000. Stick that in there. And how about our overhead? Or sorry, how about our direct labor? Okay, so here's where we've got the 685,000 candles at 6 minutes each. Divide that by 60 to get our total hours. So that 685,000 times 6 gives us the minutes. Divide by 60 to get the hours, and then multiply by $15 per hour to get the total cost of our direct material for that month. And so now our total cost, here it is, our total manufacturing cost during the month. We're going to add together the previous three amounts: the direct materials, the direct labor, and the overhead. Again, the previous three lines. So just add those together. So that tells us how much we added to the work in process account. And we started the month with 41,250. So the total work in process during the period, I simply added together the beginning inventory plus what we added to it, to get our total work in process during the period. And then if we subtract our ending inventory, so let's see here, work in process, ending inventory, desired amount, 28,500. Because we're going to be subtracting, make sure you use the negative. And that tells us how much we actually produced this month. So again, just to run through that calculation, what did we start with in beginning in work in process? 41,250. What did we add to it? Direct materials, direct labor, and overhead. So we had a total of this amount in work in process during the period, and this is how much is going to be left. So the difference is how much we actually produced, added to our finished goods. So our total finished goods available for sale would be that amount that we added to it during the month plus the beginning balance of 300,000. And there's our cost of goods available for sale, finished goods available for sale. And how much of it did we not sell? Our finished good desired ending inventory, here it is 200,000. So the 2,151,000 is how much we had available for sale. And 200,000 of that we expect not to sell. And so the difference is the amount we would expect or plan to sell. And so that's what we would build into our cost of goods sold budget. Okay. I know I'm going pretty quickly, but hopefully if you have questions, you can, go back and rewatch. Some of these exercises may possibly have a show me how button up here at the top. You can use that. And as I said at the beginning of the recording, you are always welcome to reach out with a specific question. I'm happy to help with that, help you work through something. Okay, last exercise from the budgeting chapter, and that is the idea of a cash budget. So again, this is a brief exercise, so it's not very comprehensive, but keep in mind when you're doing cash budgeting, you need to keep in mind that just because we have it in our cost of goods sold or our revenues doesn't mean that the cash flow happened in that particular month or that particular period, because we do use accrual accounting. And so cash budgeting, we need to take that accrual accounting and convert it into cash accounting. So same candle company pays 30% of its purchase on account in the month of the purchase and 70% in the month following the purchase. So if we're doing a budget here for the month of September, if the purchases were budgeted to be 50,000 for August, again, 30% of that we would have paid in August, and that leaves 70%. So $50,000 times 70%, that's $35,000 that we need to plan to spend in September to pay for those on-account purchases from August. But some of our September purchases, so we expect us to purchase $60,000 worth of stuff, I don't know, direct materials, supplies, whatever, in the month of September, and we would expect to pay for 30% of that in September as well. And again, this is not an algorithmic exercise, so your exercise should have the same numbers as mine. And we need to have available, we need to plan in our cash needs planning. We need to plan to have $53,000 in cash available to pay for the rest of August purchase and part of September's purchases. So that 53,000 doesn't line up with what we recorded in August, what we recorded in September as purchases, but that's how much we actually have to pay. Same concept applies to revenues. So if we allow our customers to buy from us on credit, we need to take into account when they're going to pay their bill as well. And in a responsible budget, we would also be building in some kind of a, an allowance, like we talked about in financial accounting in the receivables chapter in chapter 7. Okay, so that's the end of the budgeting chapter. Now we're going to move on to chapter 23, which is the standard cost and variance analysis. Alvarado Company produces a product that requires 10 standard pounds per unit. Standard price is $7.50 per pound. If 5,000 units used 52,000 pounds, so let's just think about this. Let's talk it through as we read. So 5,000 units, the standard is to use 10 pounds per unit. We should have used 50,000 pounds, right? But it tells us we used 52,000. So we already know that we're going to have an unfavorable quantity variance. It's unfavorable because we used an extra 2,000 pounds that we did not plan to use or not built into the standard. The standard price, though, is $7.50, and we were able to purchase at $7.28. So we know we're going to have a favorable price variance because we didn't have to spend as much as we would have expected, or as we built into the budget, as we set as the standard price. Now, looking at this, I can't tell you whether the cost variance is going to be favorable or unfavorable, because we need to see the total amounts here to see whether it's going to net to favorable or unfavorable. So again, I'd like you to be able to think through those, what is it exactly that we're calculating? What do these numbers mean? So the same kind of logic or explanation that I just provided, I hope you'd be able to do that on your own as well. And I'm going to get up my annotate so I can put these formulas on the screen so we can actually go through the calculations. So we expected to spend $7.50, but we only spent $7.28. I'm not putting dollar signs there, just kind of being lazy. So what happened? We saved 22 cents per pound, and we should have been using, let's see, how many pounds did we use? We used 52,000 pounds. So 22 cents per pound we saved on the, 52,000 pounds that we used. And so that is a favorable variance. I can't have both my screen annotation on and type in the boxes at the same time. So, and let's go get my annotation back up here. We just have to do this kind of piecemeal. So for part B, we're doing the quantity variance. So we actually used, 52,000 pounds, and we should have used, remember, I can put this on the screen, 5,000 times 10 pounds. So we should have used 50,000 pounds. We actually used 52,000. So we're going to have an unfavorable variance of 2,000 pounds. And those 2,000 pounds should have cost us $7.50 each. So we're using the standard price. So 2,000 pounds at $7.50 is a difference of 15,000. It tells us to enter a favorable variance as a negative number, so I'm just going to stick a negative in there. And looking at the calculation I have here on the screen, 728 minus 750, you can tell that would have come out as a negative number. And then there's two different ways we could get to this total direct materials cost variance. One is we can simply add or subtract, net together those numbers we have there. So 15,000 minus 11,440 is a positive difference of 75.60, and we know that would be an unfavorable because it's positive. The other way to do this, if it makes it easier for you to see, I guess, is actually a bit longer. And the other way we could do it, just quickly to explain, we could take the 5,000 units times 10 pounds. We should have used 50,000 pounds and should have paid $7.50 for them. That's what we expected. That's the standard cost. And then we take the 52,000 pounds we actually used at 728, multiply those together, and that gives us our actual expenditure. The difference between those two numbers would be the same as what I have there for letter C. So again, just to explain, where that number is coming from, it's the difference between how much we should have spent in total and how much we actually spent. So that's the letter C, the total direct materials variance. And I need to clear that, my drawings off the screen. And so, and we know there are three sources of variance when we're talking about product cost. There's direct materials, direct labor, and there's overhead. And we break our overhead into both fixed and variable overhead. Those look a little bit different. So for direct materials, direct labor, and the variable overhead, remember, we're going to use those flexible budget quantities. So it doesn't matter how many units we planned to produce, it's how many we actually produced. And we're looking at the fixed overhead, that volume variance, that's going to be a little bit different because, by definition, our fixed costs, we would expect to remain the same regardless of how much we produce. So moving on to our next exercise, direct labor variances. Alvarado Company produces a product that requires 3 standard direct labor hours. Another algorithmic problem here, so make sure you're using your numbers. 3 direct labor hours at a standard hourly rate of $14, just slightly under New York's minimum wage. If 3,000 units used 9,400 hours at an hourly rate of $13.44, what is the direct labor rate, time, and cost variance? So again, let's talk this through. So we produce 3,000 units, and each one of them should, according to our standards, take 3 hours. So 3,000 units times 3 hours, we would have expected to use 9,000 hours, but we actually used 9,400 hours. So we know that we're going to have a time of, an unfavorable time variance. It took us 400 hours more than our standards would have suggested. But how about the rate variance? Well, we expected to pay an average of $14. We only paid $13.44. So our rate variance is going to be favorable. Again, we have to do the math to find out whether the total is going to be net to a negative or a favorable or unfavorable, a negative or a positive. Again, just like in the last exercise, it tells us to enter a favorable variance as a negative number. So we'll be doing that. Get my annotation back up here. And so we'll start with the rate variance. So we should have spent, we actually spent $13.44, but according to the standards, we should have spent $14, and that's for the 9,400 hours that we worked. So let's do the math there. We saved 56 cents for each hour times the 9,400 hours. That is, again, reminder, you have to put in the negative. So that is a favorable variance of $5,264. We saved $5,264. However, we worked 9,400 hours when we should have only, according to the standard, worked 9,000 hours at $14 per hour. So that extra 400 hours at the standard of $14 per hour cost us $5,600. And so again, as I explained in the previous exercise, there's 2 different ways we could get to this total direct labor cost variance. We can just net together the numbers we have there and get $336. It's an unfavorable variance because the unfavorable variance outweighed the favorable variance for the rate. The other way to do this would be to look at the total. So 3,000 units at $3, 3 hours per unit times $14 is what we should have spent. And the actual 9,400 hours at $13.44, and compare those two to get the total cost variance. As you probably heard in the video, some companies might just do that total variance and then decide, well, is it material? Is it big enough that we really need to worry about this and dive into, is it, did it come from the rate or the time? So, when the computer produces these for you, it's kind of a no-brainer. You're going to look at all of them. But if you're doing this more in a manual way, if your computer isn't set up for that, then it really makes sense to start at that big picture, the macro level, and say, here's the total variance. Is it big enough that we need to spend more time diving into this to figure out where did that come from? And so I can't answer for you, whether the company would call this $336 variance favorable or unfavorable. Kind of the standard that we use is if it's more than 5% of the total, and that $336 is actually 6% of the total. Oh, no, sorry, I just did the wrong number. Nope, let me just scratch that out. So 3,000 units at 3 hours per unit times 14,000. Oh yeah, the total cost is actually 126,000. So never mind what I said. The $336 is less than 0.2% of the total cost for direct labor. There's probably no company in the world that's looking at that 0.2, 0.3% variance and saying that's material. That would be really much you might want to, think of as nitpicking. So yeah, I think we'd call it good on the $336. But, it is important if you have the need to look at that. So why did it take us 400 extra hours? Well, maybe it's because these were, more novice workers, or, they haven't received all their training yet or something like that. And so that would also explain why the rate we paid them is less than our standard. So sometimes you've got those events that are canceling each other out, right? So less experienced workers equals more time, but less cost per hour. And maybe that works out in your benefit. Certainly in this case, it came out what I would call close enough. Moving on to our next exercise then, the factory overhead controllable variance. And so, as I had suggested, the overhead variance, we're really dividing it into the amount that comes from spending too much or too little, and the amount that comes from producing too much or too little, that volume related variance. We also might be dividing our fixed and variable overhead and looking at those separately, because the reason for those variances is different. So moving on to exercise 9 then, same company as the last exercise, Alvarado Company. In this case, we produced 6,900 units. Product should take 1.5 standard direct labor hours per unit. Standard variable overhead cost per unit is $5.60, and the actual variable factory overhead was $56,680. So let's figure out first what our standard would have indicated. I'm going to show you that calculation here on the screen. 6,900 units at 1.5 hours per unit and $5.60 per hour. So if we produce 6,900 units at 1.5 hours per unit, we should have worked 10,350 direct labor hours according to that standard. And the overhead then should have been times $5.60, 57,960. So according to our standards, we should have spent 57,960, but we actually spent 56,680. So we're doing actual minus the standard, and that will give us a negative if it's a favorable variance. Again, so we should be doing that subtraction in that order. Whoops, turn that off. Actual minus the standard And because it's negative, it's a favorable variance. And so you'll notice that it does not tell us in this exercise how many units they expected or planned to produce. Why? Because we're talking here about the variable factory overhead. And so as I said a couple minutes ago, the variable costs, including direct labor, direct materials, and variable overhead, are all going to be based on that flexible budget quantity, the actual number of units we produced. Unlike for the fixed overhead, where we really do need to take into account the number of units we planned to produce. And so let's go to our final exercise from chapter 23. That's exercise 10 on factory overhead volume variance. And so here we're talking about that fixed overhead. And you'll see that it matters how many units we planned to produce. So it tells us that we were at 100% of capacity. What that tells us is, if we are, let me just, oh, yeah, I jumped too far ahead. These dollar amounts are based on 100%, and that's the standard. So of course, that's going to be based on 100%. We just don't know that we're actually producing at 100%. So sorry, I got tripped up because I'm looking at this. This is a question about volume variance, thinking, well, if we were at 100%, there's no volume variance. So it did not tell us we were at 100%. So 45, I should read the whole thing. How many times do I say that? Tell you to read every word, and then in the interest of time, I'm end up not skipping over something. Shouldn't do that. Alvarado Company produced 4,500 units of product that required 3 standard direct labor hours. So 4,500 units at 3 hours per unit is 13,500 hours, but 12,100 hours is 100% of our normal capacity. We're asked to determine the fixed factory overhead volume variance, enter a favorable variance as a negative number using a minus sign, and an unfavorable variance as a positive number. So let's get my annotate up here. Okay. So $2.75 per direct labor hour is how much we anticipate spending. And we actually see the 100% of capacity is the 12,100 hours. But we actually worked, let's see, 4,500 times 3. Okay. So 4,500 times 3 is 13,500 hours. Subtract that from the 12,100, and that's a negative 1,400 hours at $2.75. So we end up with, whoops, turn that off, negative 38.50, which is a favorable variance. Okay. So just to summarize here again, we worked 13,500 hours. Our 100% of capacity, our expected capacity is 12,100. So the fact that we were able to spread that fixed factory overhead over more hours, 13,500, gave us that favorable variance. Let me clear my notes off the screen. And we will keep going. So we're moving into chapter 24 here. The next 4 exercises are related to chapter 4. So we're in chapter 4, we're evaluating performance centers. So this is the idea of responsibility accounting, that we are holding managers responsible only for those costs and revenues and assets that they actually control. So if it's a profit center, we're looking at the income statement. We're looking at only controllable revenues and expenses. This particular exercise is for an investment center. How do I know that? Because we're looking at investment turnover, return on investment. This is a unit of the business, or a business that has the manager that we're evaluating has control over how the assets are invested in that company. And so we're going to hold that manager responsible for those investments. And it asks us to use the DuPont formula to find the return on investment, round our answers to 2 decimal places. So let me get my annotate function up here. So we'll start with our profit margin. We had operating income of $34,371 and sales of $381.9. And so our profit margin is what percentage of our sales do we get to keep? And when I plug that into my calculator, profit margin, of course, is going to be expressed as a percent. It does say to round to 2 decimal places. So, it would count it correct whether I put in 9 or 9.00. So investment turnover is how good you are at using the investment that you have to generate sales. So get my annotate up here again. So investment turnover is going to be our sales divided by the assets that we have invested. So 381.9 divided by 201,000. And investment turnover is expressed as a number of times. So 1.9 times, their investment turnover is 1.9 times. They generate $1.90 in sales for every dollar of assets they have invested in the company. Now, return on investment or ROI can be calculated directly by taking profit, operating income divided by our assets. But we are asked specifically here to use the DuPont formula, and it's actually easier because the DuPont formula for return on investment is profit margin times investment turnover. So if we multiply those two together and round to 2 decimal places, so 9%, remember to change that into a percent, 0.09, before you multiply by the 1.9. So the idea of the DuPont formula, the whole point there is to point out, to make it very clear that if you want to increase the return on investment, you can do that one of 2 ways, or a combination of 2 things. We can either generate more sales with the assets that we have available to us, or, and that's the investment turnover piece, or we can keep a higher percentage of the sales dollars that we do generate. And so leveraging either the profit margin or the investment turnover would at the same time increase our return on investment, and increasing both of them just a little bit is going to help that bottom line. And I'll clear my notes and let's keep going. So residual income in exercise 12. This residual income is another way of evaluating an investment center. So we wouldn't hold a manager responsible for how well he or she uses the invested assets if that manager has no control over those assets. So residual income. For this company, let's get my annotate here. So their expected return on their assets was 7%. So the company has decided, has let the manager know they expect a return of 7% on their invested assets. So their desired return on investment, 7%. And their invested assets are $340,000. So if they have $340,000 in assets at their disposal, and the company has said we expect a return of 7% of that, then their expected return is 23,800. Okay. Their operating income is actually, as you can see, as you can see right here, their operating income is actually 95,200. So 95,200 minus the expected 23,800 gives us residual income of 71,400. It's the extra. That's what residual means. It's what's left. It's the excess. So it's how much the commercial division of Lobo Company returned over and above the minimum acceptable return. So of course, residual income could be negative. If the company did not return at least 7%, they would end up with a negative residual income. Obviously not the position you should be in as a manager, right? Okay, moving on. Transfer pricing. So this is the last part of chapter 24. And the idea is, we've got two divisions maybe within the same company, and those divisions are working with each other. They're using each other. Maybe one is supplying another one. So if they're part of the same company, they're all working for the same team, if you want to think of it like that. So how do we decide how much one division in this case should be charging the other division? And there are a couple different ways of looking at this. The extremes are, well, we charge them how much it cost us to produce it. So we transfer at cost. The other extreme is we transfer it at market price. So what would they have to pay someone outside the company? And in reality, either the companies, the two divisions are going to negotiate with each other, or maybe the corporate level is going to tell them, no, here's the price we want you to use. And in most cases, it's probably going to be some price in between those two extremes of cost and market price from an outside supplier. So let's see what we have here. The materials used by a Harmony division of Kirtland Company are currently purchased from outside suppliers at $80 per unit. These same materials are produced by Nauvoo division, another division within the same company. The Nauvoo division can produce the materials needed by the Harmony division at a variable cost of $65 per unit. And so right now we've already set kind of in economic terms, we would call it the limits to the terms of trade. So Nauvoo is not going to accept less than $65 per unit because that's how much their variable cost is. That's how much additional marginal cost they have for producing each unit. Harmony is not going to agree to pay more than $80 because they could buy it from their outside supplier for $80. Why would they pay an internal supplier more than that? So again, we have the limits here, someplace between 65 and 80. And, some people might say, well, you should split the difference. And so halfway between 65 and 80, which would be like 72.50. Or there might be some other way of determining what's the fair price, as I put that in air quotes. The division is currently producing 130,000 units and has capacity of 160,000 units. So there's another key piece to this. They have excess capacity. And so if they were to produce and sell to that internal division, it's actually going to help them to reduce their overall cost per unit because they're going to be taking those fixed costs and spreading them out over more units. That's a key factor in this decision-making process, because if they didn't have the excess capacity, the company might be hurting themselves, possibly. Certainly the division would be hurting itself if it could produce and sell to someone outside the company for more. Why would they want to sell to someone inside the company for less money? The two divisions have recently negotiated a transfer price of $72 per unit for 15,000 units. How much will each division's income increase as a result of this transfer? And so just to talk it through, and then I'll put the calculations on the screen. So Nauvoo Nauvoo is the seller. I'm just going to go ahead and do the calculations on the screen now. So Nauvoo is the seller, and they're going to sell an additional 15,000 units. Each one of those units, they're going to sell for $72 per unit, but they're going to incur $65 in variable cost per unit that they would not otherwise incur. So that's an extra $7 per unit times the 15,000 units, or an increase in their bottom line of $105,000. They make an extra $7 in contribution margin, using a term from a previous chapter, $7 in contribution margin for each of those 15,000 units. Well, how about the Harmony division? How do they make out in this? Well, for the, whoops. There we go. For the 15,000 units, remember, they were paying $80 per unit, right? And now they're only going to pay $72 per unit. And so they're going to save $8 per unit. So their cost goes down, and therefore their profit, bottom line, increases by 120,000. Whoops. And so the total, the bottom line for this company, the parent company is Kirtland Company. The bottom line for that company is they are saving, rather than paying $80 per unit to buy from the outside supplier, they're only going to incur a cost of $65 per unit. So the net increase to the company as a whole is $15 per unit. The question of transfer pricing is, who gets that $15? And in this case, because of that agreed upon price of $72 per unit, in this case, $7 of the 15 goes to Nauvoo division and $8 goes to Harmony division. The net increase to the company as a whole is $15 per unit, and that's what's important here. That's what's important to the bottom line of the parent company. How they decide to divide up that $15 savings is why we have this negotiation happening. Okay. Let's clear my screen and move on to the next exercise. So I'm really trying to stress there isn't, the right cost. The change to the bottom line is going to be exactly the same, regardless of how you divide up that $15 between the two divisions. But you can imagine, if you're the head person in one of those two divisions, you're going to be negotiating or arguing that you should get more of it, you should get less of it, or the other team, the other division, if you will, should get less of it. Net impact on the company is exactly the same. It's just how you divide it between the two divisions within that same company. And let's move on to our final exercise from Chapter 24, Support Department Allocations. The Centralized Data Analytics Department of Drew Link Company has expenses of $265,200. The department has provided a total of 7,800 hours of service for the period. The retail division has used 5,772 hours, and commercial division has used $2,028. How much should be allocated for services to each division? And so this is a direct allocation. So we're not allocating, we're just allocating that total, 265,200, based on the hours of service. And the total was 7,800 hours of service. So 265,200 divided by 7,800 is $34 per hour is the cost. So if the retail division used 5,772 hours, that is, whoops, close that. That is 196,248. Again, that's $34 per hour times 5,772 hours. And the commercial division used only 2,028, so they should get fewer of those dollars times $34 per hour is $68,952. Okay, so pretty straightforward there. Direct allocation. We didn't allocate to any other support departments. We allocated directly to each division. And I'll clear my screen. Whoops, tried to clear my screen. Clear. There we go. Okay, and we'll move on to our final chapter for this exam. And chapter 25 is those incremental or marginal analysis. And most or maybe all of these exercises are set up to analyze the two different options and then decide which of these two options is the preferred option. So keep in mind that when we are doing these calculations, we should be looking at what's different between or among the options. For our exercises, we're typically, all the ones we did for the chapter itself, we're just comparing two different alternatives, but the process, as I discussed in the videos, what would be to kind of brainstorm all the different ideas and then maybe throw out the ones that really aren't feasible or aren't, don't make sense, don't fit in with our plans, and then maybe kind of narrow it down and start to prioritize or put them in some kind of an order of feasibility or return. And so it's not necessarily, as we've been looking at, it's not necessarily just two options, but we can assume for the sake of these exercises that the company has entertained a bunch of options and they've narrowed it down to the two best options. And then they're trying to decide between these two options, which one should we do? Felix Company owns equipment with a cost of $362,900 and accumulated depreciation of $52,600. Both of those are considered sunk costs. Remember that concept. It doesn't, sunk cost is something that's based on his decision made in the past, or a historical decision, can't be changed by any decision that we make now, and so should not come into play in our calculation. Can be sold for $277 less a 5% sales commission. That's an important piece of information because that is something that we can decide today, sell it or don't sell it. Alternatively, Felix Company can lease the equipment for 3 years for a total of $285,600, at the end of which there is no residual value. In addition, the repair, insurance, and property tax expense that would be incurred by Felix on the equipment would total $16,500 over the 3-year lease. Prepare a differential analysis as to whether Felix Company should lease or sell the equipment. If required, use a minus sign to indicate a loss. So if they lease the equipment, they're going to be able to, one second here. One second, I'm gonna do some math. Oh, lease the equipment. Sorry, I don't need to do any math right now. If they lease out that equipment, they would receive revenues of $285,600. If they lease it, they would bring in $285,600. But because they own it, they would still have to pay for those repair, insurance, and property tax expense, which would be $16,500. One thing I need to point out, I know I said this in the videos as well, that in this chapter, we're looking at short-term decision making. And so you'll notice that we don't take into account the time value of money, which, this is a 3-year project. The longer that project is, the more difference that time value of money is going to make. And in an upcoming chapter, we will be looking at the concept of the time value of money. If we sell the equipment, we could sell it for $277 minus the 5%. And so $277,000 minus the 5% would be cash flows of $263,500. If we sold it outright, we wouldn't have any additional costs in the future. Maybe they want us to show the, sorry, I think it wants us to show that 5% cost here. So 5% of the 277. Let me show that as a cost. There we go. There we go. So I just broke out the two things that I just did. And so the total revenues would be higher if we leased the equipment, if we continued to own it and we leased it out. So the total revenues would be higher. So in favor of alternative 2, no, that's not in favor of alternative 2. That's in favor of alternative 1. Alternative 1 would be preferable because our revenues would be higher, but our costs would also be higher. 16,500 compared with 13,850. Our costs would also be higher by 2,650. And so the net result, the end result, if we compare those two, 8,600, 2,650. So again, I'm showing it as a negative because the heading on the column says differential effects for alternative 2. So if we were to do alternative 2, this would be the result. And so we can see that the company should, all else equal, the company should lease the equipment because their bottom line would end up being higher by almost $6,000. I believe I said this in the videos for the chapter, but just keep in mind that, you know, this seems kind of simplistic. It seems like, well, yeah, we could have just done that without putting into this table. The reason that we go through all of these steps is because, you know, in a real world scenario, it's likely to be a little bit more complicated than the very simple brief exercises that we have here in front of us. So if we understand the basic setup, the basic concepts of sunk costs and what matters, what's incremental here, what's going to help us make a decision, we can take those concepts and expand them to apply in a more complicated and more realistic situation. Okay, next exercise. Product Omega has a revenue of 193.6, variable cost of goods sold of 114.4, variable selling expenses of 31.3, and fixed costs of 58.8, creating an operating loss of 10,900. Prepare a differential analysis as of January 15th to determine if Product Omega should be continued or discontinued, assuming fixed costs are unaffected by the decision. If an amount is 0, enter 0. If required, use a minus sign. Okay. So column 1 is to continue with Product Omega. And so that's the information that we are given in the first paragraph. So I'm just entering exactly the information that's given there in that first paragraph. So they have an operating loss of 10,900. Now, before I even start putting in the next column, let's just point out that their operating loss is less than their fixed cost. So if you know anything about economics and economic decision-making, we know that the economic decision would be if you're covering at least some of your fixed costs, you don't shut down. You only shut down when you start to exceed those fixed costs. So with that concept in place, we already know without completing this table, yes, we should continue to produce Product Omega because it is helping us to defray some of those fixed costs. And if we shut down, as we're going to see in this next column, if we shut down, we have no revenues. We have no variable costs, but we're still going to, we're still going to have those fixed costs. And so you can see in this analysis that we actually will lose more money if we discontinue that product because those fixed costs are just going to be shifted to elsewhere within the organization. They're not going to go away. Now, does that mean the company has to continue losing money indefinitely? Of course not. But what it does mean is they're going to be trying to figure out, what do we do here? How do we fix this situation? Either we need to, slim down and get rid of some of those fixed costs, or we need to, maybe figure out a way to make product Omega be more profitable, maybe find new markets, maybe see if we can increase the price. We're going to be looking at a bunch of as many different options as we can come up with to try to make that product profitable. But in the meantime, we can't just discontinue it, because as we can see in the bottom line here, we'd end up losing more money if we discontinue the product than if we just continue it. Okay, moving on, you'll notice the next couple exercises are not algorithmic. So again, your exercises should have exactly the same numbers as mine. So the next question is one about replacing equipment. A machine has a book value of $25,000. Do we care? No, because that's based on sunk cost decisions that have already passed. It has a remaining useful life estimated at 5 years. We have a proposal on the table to sell the old machine for $18,800. Is that relevant? Yes, because if we sell the old machine, we'll bring in $18,800 worth of revenues. And replace it with a new machine with a cost of $40,000. Is that relevant? Yes, because we have to pay that $40,000 to buy the new machine. The new machine has a 5-year life with no residual value. Okay, so we are comparing apples to apples, 5 years to 5 years. The new machine would reduce annual direct labor costs from $17,500 to $9,000. So replacing the old machine would actually save us money on our direct labor. And so the question is, does it save us enough to make it worthwhile? So let's look at continue with the old machine. If we continue with the old machine, we're not selling it, and so we have a $0 revenue there. So definitely in favor of alternative 2. Selling the old machine brings in cash of $18,800. But if we continue with the old machine, we also don't have to buy the new machine. So we save $40,000 there. How about the direct labor? So $17,500. If we keep the old machine, that's $87,500 out-of-pocket costs, compared with $9,000 a year for the 5 years if we buy the new machine. And so what you'll notice is between the $18,800 in revenues from selling the old machine plus the $42,500 in savings from a direct labor, that's $61,300. That more than outweighs the $41,000 purchase price. We would save $21,300. And so we should replace the old machine. Even though we originally planned to use it for 5 more years, we're better off to replace it now. Once again, I need to point out, we're now talking about a 5-year time horizon here. And so it really, at this point, I'm going to say it's beyond the scope of this chapter, but time value of money really matters here. So this $40,000 cash flow happens immediately. The, what is it? $8,500 in savings a year in direct labor is spread out over 5 years. And so the dollar 5 years from now is not worth the same as a dollar for today. And when you get into the capital investment analysis chapter, you will be reminded of how to take that into account how to calculate that time value of money concept and build that into your analysis. Because I really think by the time you're looking at a 5-year projection, that time value of money really might change your decision, especially if you're looking at a higher cost of capital. Okay, let's keep going. Process or sell. Product Tango is produced for $24 per gallon, can be sold without additional processing for $40 per gallon, so $16 profit. Or processed further into product Zulu at an additional cost of $9 per gallon. Product Zulu can be sold for $55 per gallon. So again, I'd like you to be able to think this through without even having to put it into the format that we have here. We'll then put it into the format, and as I've already explained why that is important, so that you can take a little bit more complicated problem, a little bit more realistic problem, and know what to do with that information. So we can sell it for $55 rather than $40 a gallon. That's an increase of $15 per gallon at an additional cost of $9 per gallon. If we can sell all the Zulu we make, simple analysis tells us we should process it into Zulu. We make more money in the long run. But of course, we would need to take into account, how much can we sell? What is the demand for this product? Can we produce as much as we sell, or as much as we produce? Excuse me. Can we sell as much as we produce? So let's go to selling Tango. Revenues per product, $40. Cost per product, $24. Profit per product, $16. For Zulu, sell it for $55. The cost is $24 plus an additional $9 or $33 per gallon. Profit, $22. Differential effects of alternative 2. We get an extra $15 per gallon or per unit. It is a gallon, but it costs us an extra $9. And so we make an extra $6 per gallon, and we should process further into product Zulu. One thing I just want to point out, we have discussed in the videos for the chapter that we only want to include in this analysis the costs and revenues that are actually different. And so we violated that a little bit here, the way this is set up, that this $24 cost per unit is included in this. So we do have a little bit of duplication. We did include a cost here that's not differential between the two alternatives, but it is the way that it set up this table. So we needed to do that to to get those green check marks. But in reality, did we need to include that $24 per unit? Not really, because it's not different between the two. Our next exercise is an algorithmic exercise. And so keep in mind, again, my numbers are going to be a little bit different than yours, possibly. Should we accept this business at a special price? A product is normally sold for $48 per unit. Special price of $31 is offered for the export market. The variable cost is $25 per unit. Keep in mind, when we're talking about accepting business at a special price, we need to take into account, is this going to impact our existing market, existing customers? Is it, do we have the capacity to add this? And that's addressed in these next sentences. An additional export tariff of 10% of revenue must be paid for all export products. Assume there is sufficient capacity for the special order. So this is for the export market. It's not going to affect our existing market. And we do have capacity to absorb this, which means we don't need to take into account our fixed costs because we can do this within our excess capacity right now. Prepare a differential analysis dated December 15th on whether to reject or accept the special order. So if we reject the special order, if we reject the special order, what happens? Well, we don't sell any additional product. So we have no additional costs. We have no additional revenues. Okay. We're only looking at how is this different than what we're doing right now. If we accept the order, $31 per unit, $31 per unit, and it's for, oh, this is just a per unit amount. Sorry. Yeah. $31 per unit would be our revenue. The variable production cost is 25. Should probably put that as a negative. And the export, round to 2 decimal places, 10%, $3.10. Oops, 31 minus 25 minus 310. So we would make an extra $2.90 per unit. So again, it seems kind of silly to put it into the table like this, but in a more complicated scenario, that's not going to be as clear to us. So the key pieces here, we had sufficient capacity. It doesn't impact our existing markets. Why is that important? Because if we can sell them for $48, why would we consider selling them for $31? We only would consider selling them for $31 because we don't have any $48 orders to consider. Okay. In the reference materials folder, this is our last exercise for this practice set. In the reference materials folder, there was a video that I hope you took a look at related to bottleneck and constrained resource. I think that's a really helpful video. I really like that. I think it illustrates the point quite well. Product K has a unit contribution margin of $120. Product L has a unit contribution margin of $100. Product K requires 5 furnace hours, while product L requires only 4. Using the unit contribution margin per production bottleneck hour for each product, assume the furnace is a bottleneck constraint. So determine the unit contribution margin per furnace hour. So I'm just going to put the calculation here on the screen. So for product K, it's $120 per unit, but each unit takes 5 furnace hours. So 120 divided by 5, that's $20 per furnace hour. For product L, $100, but it's 4 hours in the furnace. And so that's $25 we make per furnace hour. So if furnace hours are a constrained resource, if we can sell as much as we can produce of K or L, key there, then we would want to maximize our production of product L because we make more based on our usage of the furnace. So product L is the most profitable in using bottleneck resources. But again, we'd only want to make as much product L as we can sell. If we can use all of our furnace hours to make product L and sell all of it, we should just stop producing product K, unless maybe we can buy another furnace. But certainly we would want to focus our production on product L and be able to produce and sell as much of that as possible, because that's a better use of our furnace hours. And we have gone through all of the exercises. So again, I'd remind you that you can use that show me how button if you need more assistance, or just let me know. I'm always happy to help. Thanks for joining us.